Hello, I'm Jared Nelson from the Investing Channel, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. Most investors thought they had figured out the Fed's playbook for 2021, but no, the Fed can still spring surprises on the market. Very few expected the intense market reaction over the new dot plot last week. U.S. Treasuries and the dollar surged while stocks and commodities weakened. Given the latest jarring rotation, many are frantically asking, has the bull run reached an inflection point? In other words, have we seen the top in stocks or bottom in bonds? To some extent, the recent market rout was not totally unexpected. There were clues in the run-up to the Fed meeting. 2 weeks ago, when we talked about crude, we highlighted the base formation in the long-term Treasuries ETF. The bullish chart pattern there contradicted the recent inflation data trend, which made us wary of the inflation trade. Indeed, one of the hardest hit sectors last week were commodities, particularly miners. Gold, silver, copper miners, both large and small, were slammed as investors feared the looming taper will strangle inflation. Did you see the massive correction in lumber and soybean? Big corrections in commodities will eventually lower inflationary pressure later this year. For traders, the most relevant question is whether last week's reaction will extend further, more likely than not. The reflation trade was quite crowded after a 7-month run. There are a lot of leveraged bets in these instruments, bets that are vulnerable to sharp counter-trend moves. More stop-loss triggers are probably on the way. Meanwhile, those shorting government bonds and the U.S. dollar may have to cover, which is likely to create upward pressure on these assets. Until these trades are flushed out, chances of a further reaction are high. It will be a choppy period ahead for the market as traders swing their positions aggressively on both sides. However, the most fundamental issue is this: will the Fed really do what they say? That is, will the central bank begin to taper according to their latest statement? There is a lot of risk in that approach. The world economy is still sluggish, with many countries mired in the fight against COVID-19. International traveling is slow. Even the UK is experiencing a new COVID wave despite having one of the most vaccinated populations in the world. Premature tightening is bound to hit global financial markets. In addition, the stock market may spin into a flash crash if the bearish sentiment gets out of hand. At this point, it is hard to say if the Fed will follow the dot plot. Perhaps they are just testing the water, trying to ascertain if the market can absorb any form of tightening, verbal or real. If the market is too weak to handle even 2 rate hikes in 2023, we doubt the central bank will proceed with its plan. In fact, you can be certain that they will even reverse it or at least talk it down. At this juncture, we think it is not the right time to recommend a particular macro trade because most macro instruments are so tightly linked that they move like one giant trade. Look at how the macro instruments correlated last week, jumping up and down together. It didn't matter whether the miner was good or bad, or if the commodity was in deficit or surplus. Therefore, it may be better to look at single stock trades rather than a thematic approach. And in this wobbly market, we prefer to buy stocks with good relative strength. For example, the tech sector is withstanding the correction better than other sectors. Some stocks are even breaking out to the upside. One particular stock that caught our attention is PayPal, the $330 billion NASDAQ-listed payment company. The company was formerly owned by eBay. In 2015, the company decided on a demerger and listed the payment company as a separate entity. PayPal's bull run began soon after. The stock really took off after the pandemic. Its share price nearly quadrupled in a mere 10 months. Following a multi-week consolidation, prices are pushing north again. Last week, prices decisively broke the $275 ceiling, a move that suggests another leg up into $300. Still, in the same sector, Square is also worth watching as prices push north of its trading range. Another tech stock on a bull trend is the recently listed Squarespace, currently trading at new all-time highs. Of course, the bears will say these uptrend renewals will not last because the general market is weak. Frothy valuation, a less accommodative monetary policy, and lingering effects of the pandemic will continue to weigh down the market. It is possible that the first great upwave from the pandemic lows is over, but the Fed is far from tightening. Typically, major bull markets end parabolically. We haven't seen that yet. Another leg up is not to be discounted. All in all, we could be heading for a volatile few weeks. The sell in May strategy is definitely still intact. That's all we have time for this week. Remember, make sure you do your own due diligence before making any investment decisions.